It's difficult, obviously, because commodities have gone from the super cycle has been justified. So we've had a super boom, and now we're having a super bust, which is going to go on for several years, I think, in many of those commodities. The banks obviously have their own issues with having raised all the equity, and clearly there are, it's going to take a while for them to be able to grow their dividends, and things could go possibly worse for the banks if property prices come off, because their bad debts are at very low levels. And then you look around at the rest of the market, and the environment is difficult for most companies to grow their earnings. And the ones that are growing their earnings, like Brambles and Amcor, are on huge premiums. So it's a very tough market, I think. Yeah, we're probably holding a little bit more cash than we'd ordinarily hold, waiting for the right things to come along, either new IPOs or perhaps a correction in some shares that we like. So, I think it's fair to say we're holding a little bit more cash. We're limited by how much cash we can hold. But look, we're happy to be patient and wait for the right opportunities. Yep, look, I think we've talked about this before. We've at IML, we've had the view that the economy is going to be, flat to pretty tough for a long time. So the areas where we're looking, I think we've said this repeatedly. We're looking for companies that can grow out of their own steam. So companies that can make, accretive acquisitions. So we like companies like Steadfast and Pact Group, who've got a track record of good management and knowing what to do with those accretive acquisitions. We're looking for companies that have got some growth locked in because of, obviously, they're either an infrastructure play or a shopping centre, like Shopping Centres Australia, which has got leases with Woolworths for 20 years. Spark Infrastructure, which has just had its reset of its utility thing, where it's given guidance for the next 3 to 5 years as to the distribution they should be making. Duet is another one in that category. AusNet's another one in that category. Companies which are restructuring, so companies like Fletcher Building, we think, are sort of in the midst of a restructuring. Again, it's not going to lead to a doubling of the share price, but we think the company can do better if it offloads its non-performing Australian assets and focuses on its better assets. So again, we're looking, as I've said for a year or two now, or three, we think the economy is going to remain fairly soft, fairly patchy. And the only way you're going to find earnings growth is from companies that can generate it themselves through some self-help or through lock-ins of regulatory rates or whatever.
You mentioned there companies that can make accretive acquisitions.
Mm-hmm.
We have seen a number of companies growing by acquisition that have unwound and come unstuck.
Mm-hmm.
Where's the line there?
Which one? Sorry, James, I'm just
Slater and Gordon, Vocation.
Yeah.
Was one of the.
I guess you have to look at have they had a long track record of acquisitions, or is it something that's sort of accelerated quickly as the company's gone to IPO, which tends to happen to make things attractive. In the case of Vocation, I think the acquisitions actually happened on the IPO. If you look at a company like Pact Group, for example, which started in 2002, I think they've made something like 70 or 80 acquisitions over the last 14 to 15 years. And, they've been very careful with each one of those. If you look at Steadfast again, same managing director, he's absorbed and grown the business by acquisition for many, many years. So I think you have to look at the track record of these. You're correct. Acquisitions can be very risky, particularly if you overpay for things. I think what you have to look at is you have to see who, are the people who are making these acquisitions, have they had a good history of acquiring at the right price and successfully integrating the new acquisition into the business? I think that's the key. And often with a lot of these things, as you say, they seem very rushed, and they seem often rushed because there's an IPO on the way, or you're trying to raise money, or you're trying to grow exponentially in a very short period of time.